Hey everyone. First off, just want to say how proud I am of how our clients have handled this year. We had a shaky start to 2025, a lot of headlines and a lot of uncertainty, and yet you stayed invested and you stayed steady. And because of that, you participated in the market rebound. I've been very happy the way things have unfolded since the beginning of the year, because one of the best lessons I've learned, and I say learned, even though I've never met the man, is from Warren Buffett. From reading his annual letters for years, he says this quote, or something along those lines, that you want to outperform the markets during the downturns and participate in the market in the bull markets. Meaning when things are bad, you want to participate as little as possible. When things are going well, you want to participate, but you want to stay in that sort of range because things can get overheated one way or the other. And that's where opportunities in the markets present themselves. And that's exactly what we did together this year. So what I'd like to do next is talk about where things are now and where they might be heading, because right now we're seeing the markets near or at all-time highs, depending on when you may see this video. Even though there have been some geopolitical risks that have been rising that we've been seeing throughout the year, there is a lot of cautious optimism building around the peace efforts in the Middle East. Obviously, that's been something that's been in the news for as long as I can remember, and probably as long as you can remember. On the trade side of things, many large investors are appearing to willing to tolerate some tariffs on China, but not too much. And before the year's over, I would expect that we start to see, how are tariffs actually going to affect things. Wharton professor Jeremy Siegel was recently suggesting that tariffs, well, this is a given, are inflationary. I mean, they're basically a tax. Even Warren Buffett has said they're an act of war in some cases, but investors may view them as a cost of global repositioning. And while that's happening, technology and artificial intelligence remain key growth drivers, and innovation is helping companies push through the economic headwinds that we've been seeing throughout 2024 heading into 2025. And really, that's what has been driving the markets up, is more business to business investment versus consumer-led economy. So it's really been a business-led economy, and that's been because of artificial intelligence and all of these chips. There's a risk with this. I mean, a recent report showed that 50% of companies say tariffs are now impacting more than half of their products. And that's going to be pushed over the consumer, such as myself and you. And what that's leading up to is a preemptive inventory buildup. And as those stockpiles get drawn down, we could see a slowdown heading into 2026. No one really knows. No one has a crystal ball. And that's definitely something that we're watching. Now, let's shift gears over to the Fed. So the remaining things that we want to be aware of heading into 2026 that are going to be pivotal are inflation, consumer spending, and labor markets. So increase in prices, how are people spending their money, and how are the markets doing in terms of employment and unemployment? And all of this is going to feed into what the Fed does next with interest rates. Now, we just got a small cut this month in September, but we're still unsure what the remaining cuts might look like heading into the future. The odds of seeing more rate cuts, it seems more imminent nowadays, but I mean, the Fed still says they're going to be cautious despite what our fearless leader might be tweeting out to everyone in the world to see. And we've heard from Vice Chair Michelle Bowman recently say that if inflation continues easing, cuts are still on the table. But the Federal Reserve has said that they're very data dependent, and they're only going to do that if the data holds. And here is something also important to point out from Wharton Professor Jeremy Siegel. He says, if inflation comes from tariffs and not from demand, the Fed should not rush to change rates, meaning we don't want to swing too much and just cut rates by a full percentage point. We saw that in September. They cut like a quarter of a point. And that's something that we agree with. We don't want to just, throw all caution in the wind with everything, because there are a lot of global risks. And right now that wild card is Iran. Any move toward negotiations, especially from a weaker position, could ease tensions and help support the markets. But if diplomacy fails, or if we see military action escalate, the markets will likely respond quickly and not in a good way. And we saw that when there was that attack with Iran and Israel, and oil prices were starting to spike. And we positioned our portfolios to be ready for if or when that could happen, or maybe it never happens. And this is where it comes down to leadership, United States, Israel, and getting the terms laid out correctly. And Iran's response is going to give us the signals on what's going to happen in terms of this macro risk, because it's a meaningful one. And it's something that we're watching closely, and it's something that we're prepared for if it ends up becoming an issue. Now, we got to talk about the one company that's been stealing the spotlight for the last several years, and that is Nvidia. As of this past quarter, the third quarter of 2025, they represent nearly 8% of the entire S&P 500. That is the largest individual weight in the index since 1981. And that's what we've been seeing, is they've really been fueling how the markets have been performing, because they're 8% of the overall market. And while that's a testament to their company's dominance, it's also a concentration risk. We recently saw that they actually invested a bunch of money into Intel recently, and people are starting to speculate on that. You may or may not remember Microsoft actually invested money into Apple back in the day. And recent reports are showing that the top 10 stocks in the S&P 500 now make up over 37% of the overall index. So the big question is, what if sentiment turns on mega cap tech? And that's been the question for quite some time. And that's why we always want to return to the basics of investing. Remain patient, don't chase, own quality. So what exactly are we tracking from here? First, we want to focus on economic data, and that's a huge one. Second, inventory trends after the tariff moves. We want to make sure that we're watching for signs of any slowdown. And third, we still want to evaluate how artificial intelligence is helping firms offset cost pressures. And we've seen large companies letting people go from their jobs because artificial intelligence is essentially replacing them. And with Nvidia, what is their influence on the market? Because it's a massive position of the S&P 500. And this just isn't noise on your market radar. So to bring things into perspective, a couple things. We got optimism powered by tech and diplomacy. And we have real risks from trade, valuations, and geopolitics. But I'll say it again, I'm proud of how you've handled this year. You stayed disciplined, you stayed focused, and that's what real investing is all about. At 369 Financial, we believe in growth, the kind that's steady, smart, and long-term. We believe in family, and that you're part of our family as well. And lastly, we also believe in philanthropy, building wealth that also is able to lift others. I promise that I will continue to be your voice of reason through the noise, through the good times, and through the bad times. If this gave you some clarity, feel free to share it with someone. And as always, if you have questions, feel free to reach out and schedule an appointment so that we can make sure that your financial plan is on track. And again, as always, I'm always here to talk through what this all means for your plan and what's exactly important to you and your family. I'm here. And until next time, stay thoughtful, stay grounded, and let's keep growing together.